Yo, what's up, everybody? Michael Silva here. Sorry, my voice is kind of deep. I'm losing it. I'm not losing it. You're watching the Stock Market Review Show. I don't know why I did that. We got a lot to talk about today. What a wild day in the markets. If you were paying close attention, if you weren't, don't worry about it. We'll talk about it. We're going to hop right into it. The big mover today was the dollar. The dollar took off, and, we've been saying the dollar has a negative correlation to the S&P 500 and various equities. Well, it took off, and you can see here the S&P 500 finished rather flat on the day. Some would think that the S&P 500 could fall, so you might be thinking, well, why didn't it? Well, it's because of big tech. So what was the other component to all of this that was taking place? The 10-year yield backed off significantly, which I guess tech liked, but it can like it to an extent, and it could also, that correlation could break. But what we saw today, tech was up, held together the S&P 500, but the dollar went up, and the dollar, or actually I'll get into that momentarily, but the 10-year yield, when this falls, you can see here the correlation also that got hit was the cyclical correlation. So we look at like energy ratio to SPY, that's the black line. You can see they move hand in hand. So when the 10-year yield got hit, energy was one of the worst performing sectors today, and that came down too as well. Interesting stuff. If we move on, you can see oil took a big hit. That was another big market mover today. Big volume break. We said, actually, we've been saying watch oil here, because if it starts taking out this level, we could break down to around the 200-day moving average. That doesn't necessarily mean that oil is going to be crashing completely, right? The rate at which this is moving and the volume supports further downside. But just keep in mind, like, it's still above that 200-day inclining moving average. We have a low, higher low. We just finally broke some of these lows. So if it comes down into this 95, 90 range, it could very well base off, and we could get some rip-facing rallies still in this environment. So be just aware of that. If you want to see the correlation here when the 10-year yield backs off, what tech does, you can see here the 10-year yield backs off and tech has been rising. Now, if the 10-year yield continues to back off, hey, maybe tech gets a little bit more of a relief. But just remember that correlation doesn't always hold, right? The 10-year yield can rise and tech can rise. It's the rate at which they move is what really impacts that market. Now, the dollar rising, what got hit? Well, energy got hit, cyclical got hit, gold got smashed. So gold, big, huge red bar, black bar down on the day. Gold, you can see, took off. So the reason why you're seeing gold, silver, miners getting hit to the downside very hard, it is because of that big rise in the dollar. You can see here, we talked about miners the other day, had that bullish engulfing candle. We said we just need to kind of wait for follow-through. Didn't get the follow-through. We gapped down and closed basically at the open of the prior day with some decent volume. We do still have a positive divergence holding. So I want to talk about how you play this while the market is kind of falling down, because this right here is considered catching a falling knife. Now, if the price action was above the 200, I would say, okay, you're just trying to play that pullback into it, but we are below all the key moving averages. So at this point, if you're buying it without confirmation, you are trying to catch a falling knife. And that's in specifically the miners. You can look at GDX, GDXJ, XME, etc. So if I just bring up a blank slate here and we say, hey, this area down here is, a level of support. Okay. And then we have our price action in yellow. We'll do yellow and it's coming down like this. And say we break down through that area of support. Buying right here at this level, like, you're taking a lot of risk on. So what I say you do is you buy the right side of a U-turn. So wait for price to make a U-turn and you buy the right side of it. So if price were to come back through that area of support, what this does right here is, instead of buying it at this level of support and having to deal with this move to the downside, you're in essence, you're buying the same price, right here versus right here, but you don't need to deal with multiple days, multiple weeks, multiple months of this downside movement right there, okay? And if you do that, what's also nice about it is it allows you to get an idea of where a stop loss could potentially be. So you'd be buying into strength and seeing if we start to kind of curve back up, you'd have a stop loss, and then every turn that the market potentially gives you, you can update that stop loss. So that is one thing that I'd be looking at as far as the miners go. You can see here they continue to go hand in hand. Silver got hit to the downside, miners go down to the downside. We talked about in that yesterday's video. I will say that silver is, it's sitting still right at that 61.8% retracement level measured from the COVID low to this recent peak. So that is something to potentially pay attention to. And you can see here on the weekly time frame, we are pulling down to around that 19 area, which that was some breakout areas where we saw some volume did step in. So we'll see here if we can get some sort of a bounce or it can start to base out. But as it stands right now, just be cautious. And we got a lot of things to be cautious about, right? So volatility was up today. We gapped. We started pulling back. Where are we at? Yesterday, we talked about the calculation of what this number actually means. So if you don't know, watch that episode because I actually go into detail about monthly and quarterly timeframes. It was a longer episode, but it's probably one of the more important ones too if you want to look at what's going to be taking place this month and this next quarter. So what does this number mean? Well, essentially right here, 27, it means that it's S&P 500, and this is always updating this number. It expects around 27% move in the next year, right? That's annualized. In the next month, 7.79%. In the next week, it's saying this is the S&P 500 is expecting a 3.74% move, and in the next day, it's expecting a 1.7% move. That is plus or minus, and just understand it's based off of options, right? So it's with the implications. It's with the idea that 68% of the time the options market is going to be right, which is with one standard deviation. So it's basically saying tomorrow the S&P 500 currently where the VIX stands, it's basically saying there's a 68% likelihood that the S&P 500 will move less than 1.7% plus or minus tomorrow, less than 3.74% for the week, and then so forth for the month, for the year. Okay. So let's continue on. VIX, like I said, it's still relatively high. This is very volatile. Okay, that's why I'm saying that. That's why I'm bringing it up. The NASDAQ volatility came off a little bit too, but where did we close at? We're at 34.86. It's still high, okay? Russell volatility, 33.36, still high. It's in the 30s, right? So what does this mean to a trader? Well, it means you need to be a little bit more tactical, more aggressive, right? It's not like a portfolio manager where we're down here below 15. You can let your positions ride. When you're in higher volatility, if you have an account, this is basically saying that, hey, you have more risk, a lot more risk, because the moves in the market are are just a lot greater than what they would be if they were below these levels down here. Okay, what else do we got going on coming up? Well, we have earnings coming up here soon, right? So here's financial sector. We have financials earnings coming out here just next week. We have JPM, 7 days, Morgan Stanley. We got Wells Fargo coming out in 8, Citigroup, and so forth. You can screenshot that if you want to take a look at it. And then earnings are a little bit later for the large mega cap stocks. You can see here, 17, 15, 15, 15, 17. That's Apple, Microsoft, Google, Amazon, Tesla, and then so far down the list, okay? You have UNH is also one that's going to be pretty soon here. That's a big market cap. That's in 8 days. Okay, so that is definitely something to keep an eye on. And the reason why I say keep an eye on this stuff is because we don't have the earnings yet, but it allows for a potential more of a rally for a little while, what we're seeing in the markets, and we'll get into those momentarily. But it's to be very prepared for when these earnings come out, because that could shake the markets right back up again. Another thing to consider still is these yields, right? The yields, like we said, are already backed off today, but take a look at that 3-month yield. This thing is firing off like a rocket ship. And what does that do to the 10-year 3-month curve? Look at this thing. It just got under 1. It was literally at 1.26 like 2 days ago, 2 trading days ago. It's at 0.92. This thing is falling off the edge of a cliff, heading towards inversion. The 10-year, 2-year, it's back to inversion. It's at 0.00 right now. So we are moving into that inverted territory. Could be an indication, obviously, that we're going to start seeing headlines more about recession, less about inflation, moving forward. If you take a look at the 11 sectors that make up the S&P 500, how did they perform today? I mean, not all that great, right? What held the market up was communication services, consumer discretionary, and tech. When you have these big dogs leading the way with some good gains, that's going to help the NASDAQ 100 for sure, but it's also going to hold the S&P 500 together. The S&P 500 finished rather flat, and that's because, energy is a big player and financials is a big player, and those both finished down. So, just like when we saw the S&P 500 doing good from a relative basis, that was because energy was, for the last 3-4 months or whatever, basically this year, it's been doing good. But now we're starting to see it weaken up a little bit. So we'll continue to monitor that, see if anything develops. Yesterday, we talked about the summation index, right? About the parabolic SAR. It did click under, indicating that we could have a shift in trend here where we can start heading up. We are still below 0, but that is something to pay attention to, right? The positive divergence. You had a lower low in the New York Stock Exchange, and then the Summation index here is starting to trend up. We'll see if that can continue, giving us like, a week, 2 week potential rally, which we'll get into the seasonality chart momentarily. This is the summation index for the New York Stock Exchange. This is the summation index for the NASDAQ. So I'll show this too, every once in a while, but you can see here it did something very similar, a low to a lower low, a low to a higher low, and the parabolic SAR here has actually been triggered up for multiple trading days, and you can see we came down and we're just kind of moving up slowly. Another thing to keep in mind with the Nasdaq Composite was that obvious falling wedge that we were talking about with that positive divergence on the McClellan oscillator there too as well. So some bullish things taking place, right? If we take a look at the updated put to call ratio chart that we discussed on the last video, saying, hey, is a buy signal coming? Well, it is if the 10 period moving average of the put to call ratio falls below 0.95. I'll tell you what, we got a 0.90 reading today, which is kind of bullish. So if this thing starts to head down lower, that could indicate a potential buy signal here early start in the month of July. So we'll continue to monitor that. That doesn't mean, by the way, I feel like a lot of people can get that confused. Like that means like, oh, go all in. It's just something to be aware of, right? Like we're in a bear market. So that's why, once again, if you haven't seen yesterday's video, make sure you do, because it's a bear market. So if you're running a long book, short book, right? Long and short, you may be more bearish bias, but that doesn't mean that you can't put on long positions, right? So I'm long, right? But we've been talking about what I'm long: China, biotech, those type of stocks right now, because those are the ones looking like they're setting up bases. But now we're starting to see, obviously, a couple other things develop. If we look at the old fool indicator, this still hasn't crossed over yet. So I'm going to be continuing to watch that to see if there's a bullish crossover here, and maybe we start getting that little rally. It's too early to really tell. This was the ratio we talked about the other day. That bullish divergence has confirmed, right? We did get a lower low here to basically even on the ratio, but a higher low on the S&P 500. The last time we've done that, we've seen some rallies, right? We got a rally there. We got a rally there too as well. So, hey, it's something to watch out for. Let's hop into the seasonality chart, and so I can kind of wrap this up, and then we'll get into the 15-minute time frames. So we are in the month of July. All right, July to August. Shabba-dabba-doo. Okay, new quarter. And you can see all midterms. Democratic midterm is the purple line, and then you have all years. So let's take a look at the purple line. The purple line into July right here, you can see we rally up to around the middle of the month, a little bit less. So let's call it 10 to 12 days. Okay, so what does this tell you? Well, I'll tell you what it tells me. And by the way, this is just an opinion, right? But what this tells me is we have, first off, there's a lot of things to be bearish about, right? So we have, I'm not going to even get into that because I talk about it so frequently. But the big thing here is we have earnings in a week or so. So what, the market may have priced in a lot of these, things, but we don't know about, future guidance. So we have earnings coming out, which could very well increase the volatility of the markets. I expect it to increase volatility, whether that's to the upside or downside. We have these yield curves inverting. All right, we have all kinds of things to potentially be bearish about. So what this is telling me is, hey, if you're positioned long, it might be ideal to start looking to reposition yourself or add to bearish positions or reduce long positions when you start getting into the middle of July here. And just to give you more kind of a view of that, what am I looking at? I'm looking at the weekly expected moves. I'll look at the S&P 500. We started off the day, big gap down, but we rallied up throughout the rest of the day, kind of really just shaking up a lot of people. RSI is getting a little overbought, but we're back above that 5-day moving average. It's slightly declining, but it's rather neutral for the most part. So if we start to rally here in, to the 10th, to the 11th, to the 12th or whatever, that's could potentially bring us up to that upper edge of the weekly expected move, potentially even to try to fill a gap here if we get outside of it. And at that time, it might be, if we do get up there, it could be ideal to start looking to take profits or reposition yourself to potentially be short. Doesn't mean that you need to short when you're below or above a 5-day moving average, but it is something to just be aware of. If the 5-day moving average comes up, price gets here, but then we start coming back down through it, this could be an ideal thing to watch out for, okay? Hope that made sense. Here's the Qs. The Qs also just a big rally. RSI getting a little overbought. It looks like it could come tag the upper expected move, so just be aware of those levels. 5-day moving average, it's still declining, but it's rather flat, so we'll see here if we get a back test. And maybe, if we do get a back test, look for strength, and then maybe it can take out that high and come take out that, and you can have a stop there. That'd be, one way of looking to play it if you're looking, to play it tactically. The IWM, very same situation. Look at this just move. It's a gap down, move down, probably flushed a lot of players out and just moved straight up throughout the day. Absolutely incredible price action right there. So we'll see here if we can get some continuance of this. Lately, we haven't seen like multiple day rallies. It's just been this chop bucket, as you can see. Go just looking to the left of the screen, right? We've just been here in a sideways range. It's the same thing with the Qs, right? It's chop, 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 chop. And, the same thing with the spiders or the S&P 500. Chop, 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 chop. So we don't have a really bullish or bearish trend. We're neutral, which means just play the range or just wait until we get some confirmation. That's how you go about it. So hope today's episode worked out, everybody. If you're not part of the Swing Trader platform, $9 a month or just pay annually. That's $90 and ends up being like $7 a month. You can come in and get some Discord benefits. You get swing trade setup ideas that I post in the Discord. I'll put out my weekly watch list via Excel and PDF. I list expected moves, which is, I teach people how to do that too, but I give like a product list of like 40 something products to give you an idea of where they could potentially go every single week. And then you have obviously an amazing chat community there too as well. So hope today's episode helped out, and I'll see you back here on the next. Toodaloo.